So we're back with you on the program, live from Abuja, the country's political capital. I am Bosun Mafai. Let's get on with the conversation. Let's get into the commodities, energy, and a few other conversations over the next couple of minutes. But let's start with where we are at the moment. You saw yesterday the manufacturing data from FBN Quest, and overnight the Central Bank of Nigeria also released its manufacturing and non-manufacturing data. Is a bit of a disparity on the numbers. The FBN Quest numbers showed a 15.0 uptick from 48.6. The figures from the Central Bank showed a contraction to 44.4 for non-manufacturing. So inflation expectation is also part of what we're considering. Let's bring in Amaka Ajegbo, who is one of the investment research analysts at Financial Derivatives Company, live from our studios in Lagos to chat to us for a couple of minutes about these numbers and expectations on domestic agri prices. Amaka, good morning. Thanks for coming through.
Good morning. Thanks for having me.
Okay, now let's get on with this. You are analysts at FBN, sorry, I beg your pardon, at Financial Derivatives, FDC, looking at inflation trending slightly lower in the new month. How do you arrive at this? What are your permutations, as it were? What do you think will be responsible for this? Because inflation 18.8, we're looking at 18.5 from what you are sending out. Exchange rate is also one major consideration, and with the manufacturing and non-manufacturing data coming out, we need to find out from you. Talk to us.
Okay, so our analysis at the Financial Derivatives Company think tank leads us to believe that.
Okay, let's quickly we'll try to patch up the audio there to get Amaka Ajegbo from Financial Derivatives to talk to us. Let's tell you a little bit more about the overnight data from the Central Bank of Nigeria, as far as the PMI, the Purchasing Managers Index. It reflects the level of industrial or manufacturing activity in a particular economy, and what the Central Bank sent out that the numbers were disappointing for the month of February. That was at variance with what FBN Quest, an investment research firm, posted out also on Tuesday. Then the Central Bank data came in late yesterday. Manufacturing PMI reading 44.6, non-manufacturing 44.4, down from 49.4 in the month of January. These figures tell the level of what is going on in the manufacturing sector of the economy, shows the level of manufacturing activities. Now, the Central Bank data shows that the country's manufacturing sector declined in the month of February, and that was due to a number of factors, cost of energy, transportation, and, of course, the currency behavior. This is a broader index. If you're trying to make a difference, then you need to look at the difference between the basket of what the Central Bank measures as its PMI vis-a-vis what FBN Quest actually did. We got Amaka Ajegbo back loud and clear. Amaka, good morning.
Good morning. Hi, Bosun.
Now we can hear each other.
Okay,
so I'm sure you heard my first question. So how did you folks arrive at this inflation slight dip that you forecasted?
Yes, so our analysis led us to believe that inflation is going to taper slightly to 18.5% due to the presence of base year effects. So the base year effects are finally waning in February, because if you look at year-on-year analysis, you see February last year was when we saw the spike from 9.6 to 11.5% in inflation. So starting off with a high base, we can see that inflation will slightly taper in February.
Okay, so welcome to March. I need to say that, yes, let's have a good March together. So goodbye February, as it were. What's the outlook on local prices as we step into the new month? Do you think the basic challenges will remain, and where do you see prices moving?
Okay, so for the month of March, given our economic climate right now, agri prices are slightly sticky downwards, so expectations of dramatic changes in the prices of these agri-commodities is quite misguided. And also we need to factor in that we're approaching planting season, so there's an inverse relationship between the price of some commodities, of some agri-commodities, and the planting season. So we need to factor that in. But having said that, we can see policy reforms around us. So you see reforms in the power sector, we see reforms in the forex market, we see reforms everywhere. So this is giving farmers and stakeholders in the agricultural sector leeway to get on with production and also distribution. So power, we look back to January, we had power at the grid at 1,500 megawatts, which was very, very inconsequential to the demand for power in the country. But now we've seen an improvement to 4,000. So what that means is that it tapers down the frantic demand for diesel to power generators and power trucks and instruments that use diesel. So that would also factor into the price of agri-commodities, in the sense that diesel, we're expecting diesel to trade between 265 and 275 per litre in the month of March. So this would reduce the influence of supply side shocks on inflation. So yes, so prices, the environment is conducive for prices, all things being equal. Hello?
Yes, all things being equal, as you economists and others would say, all things being equal. Yeah. But do you see the rapid fireworks of the central bank at the currencies market as a major move in the month of February that will have some impact on prices of domestic goods or agri-goods in the new month of March, perhaps into April?
Yes, so as you said, domestic goods, so these are relatively exchange rate insensitive. But then, based on analysis at our company, we were starting to notice, a two-directional impact of exchange rates on domestic prices, so through export smuggling. So these farmers are trying to capture the margins in the markets, in the forex markets, by exporting their goods illegally to regional countries to earn forex. But now, seeing the appreciation of the currency in the markets, that means our exports are more expensive. So this would discourage this regional demand from patronizing our goods slightly. So we can see the downside risk that we were anticipating from export smuggling has mitigated slightly. So the effect of this currency appreciation is flat to positive on the long run, the medium to long run.
Finally, Amaka, I'm still a little bit uncomfortable with the price of rice and sugar, all of them in double digits of thousands.
Yes. But then we are comparing year-on-year prices. So over the course of 2016, prices more than doubled for these commodities. But then we're starting to see a slight tapering in these prices. It's not going to happen overnight. Like I said, these prices are slightly sticky downwards. But then we should expect, all things being equal, the policy reforms in place, moving on from, policy silence to, proactive actions in the several markets that we consider. We should expect that the prices of these goods will taper as we move along.
Okay, I'm going to hold you to your forecast that these prices will move down a little bit. Amaka Ijebu, thank you very much. When it gets down to single digit, I'm looking at a lot of double digit here: sugar, flour, beans, cement, gari, rice, and whatever. If it gets to single digit, I'll give you a handshake. Thank you. Meantime, this is my handshake from Abuja. Thank you very much for being there for us this morning, talking up the commodities market. Amaka Ijebu, a research analyst from Financial Derivatives Company.